Buy your gold and silver from SD Bullion. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Hey everybody, Smart Silver Stacker here. Hope you're doing well. Today we're going to talk about the possibility of a crash in the price of gold and silver. And in this case, it would be driven by the Federal Reserve and how likely this is to occur. So we're taking a look at the chart of the price of silver. You can see it's been under some pressure so far in 2024. Today, down right around 23 bucks, coming under some pressure today. Same story for gold, down to 2027. Now still holding strong above the $2,000 level. I got to tell you personally, I think we're going to stay above 2,000 in the gold price. But why are they selling off, and what could cause them to come under some additional pressure? That is the precious metals. Well, it's all about the Federal Reserve, of course, as just about everything is in this economy in which the Federal Reserve sets the price of money, controls interest rates. And as you can see here from the CME FedWatch tool, the anticipation of Fed rate cuts have been on the decline. According to this tool, the 29th of December, 2023, markets were only anticipating an 11.5% chance of the Fed maintaining current interest rates at their March 2024 FOMC meeting. But now, as of today, that number has climbed all the way to 36.2%. So some of this is because the Fed has been implementing this damage control of sorts. Some of it has to do with the last jobs report that we got, which on the surface looked fairly good and beat estimates. Of course, if you dig down into the numbers, I think you can find that the U.S. job market is not nearly as strong as we are being told. And this week will be very important because we're going to be getting the CPI numbers, the official inflation data for December. This will have a big impact on whether investors believe the Federal Reserve will commit to easier monetary policy soon here in 2024. The idea being that if we get a hot inflation print, that may discourage the Fed from resuming easier monetary policy, cutting rates. If we get a low inflation print, if inflation looks like it's easing, that may actually put gold and silver under some additional pressure. So we're going to have to see how this goes. But the inflation print is going to be very important. But look, I am fairly convinced that the Federal Reserve will be printing in a very big way in 2024, and that is why I view the current decline in the gold and silver price as a blip, as a buying opportunity, as something which is likely to reverse once investors realize what is in store for them in 2024. And let's get into the reasons why I am so convinced of this. First of all, we've got this story. Congress agrees to $1.6 trillion spending deal, but shutdown still looms. So we're on, January 8th of 2024, and already we are once again hearing about the looming possibility of a government shutdown. I mean, this is every couple months right now, and what is happening here is, despite the massive volume of deficit spending, the return on that in terms of economic growth and in terms of economic stimulus is diminishing. And so the government is having to spend massive quantities of money just to try to keep this debt-addicted economy afloat in this environment of higher interest rates. But the problem is that inflation remains stubbornly high. But at the end of the day, what we will see is more and more government deficit spending, as evidenced by this agreement preliminary agreement to spend an additional $1.6 trillion. Now, they still have to hammer out the details. So I think they have, 10 more days to figure this out before the government shuts down. But we're going to continue to hear about this in 2024. I would say it is very likely we will avoid any kind of government shutdown, but they always float these stories out there to try to convince everybody that it is absolutely necessary that the government continue spending massive sums of money in the form of deficits. Now, you can see that reflected in the U.S. debt clock here, the U.S. official national debt now exceeding $34 trillion, and this number is going to grow dramatically in 2024. Now, the reason that ultimately this will be good for gold and silver prices, and why I think even if they do crash in the short term, they're ultimately headed much, much higher, is because all of this debt is going to need to be monetized eventually by the Federal Reserve. That's why I believe the Fed is not only going to return to cutting interest rates in 2024, there's a very good possibility that they could return to quantitative easing. Someone has to buy all of this debt eventually, or interest rates will soar. So I believe the Fed is going to have to come in here, buy up the debt, keep interest rates low. And, one other reason, actually, before I get to that, I do see someone here in the chat saying, congratulations for 60,000 subscribers. Yeah, I wanted to mention that. We did just hit 60,000 subs here on the channel, and I want to say a huge thank you to all of you viewers, all of you subscribers. If you're not subscribed yet, consider smashing that button to see more videos like this in the future. And also, if you wouldn't mind, just do me a favor, hit that like button here if you are enjoying the videos so far. So let's talk about why else the debt is going to continue to balloon in 2024, ultimately forcing the hand of the Federal Reserve to ease and to print much, much more fiat currency. The escalations in the Middle East. This is something we cannot neglect. And, I think this ultimately will be a reason that we see the price of crude oil move much higher as well. Right now, we have kind of alternate forces at work in the price of crude oil and commodities. You've got a global economic slowdown. You have a glut of supply in crude oil. Today, the Saudis actually cut the price of their benchmark crude products. So you've seen the price of crude oil falling today, but at the same time, you've got this looming conflict in the Middle East, which ultimately I believe will lead to higher commodity prices and much, much more creation of debt, because war, of course, one of the most inflationary endeavors a government can embark on, very expensive thing to embark on. We've got today a report of an Israeli strike killing a Hezbollah commander in Lebanon. This was the highest ranking, most senior Hezbollah officer killed so far in the conflict. Now, why is this a big deal? Well, this threatens to open up that second front in the Middle East war. This is coming as a result of a series of escalations. Earlier last week, we had Israel launching a drone strike in Beirut, so inside of Lebanon, killing a senior Hamas commander who was staying in a Hezbollah stronghold. Then you had Hezbollah firing rockets at Israel. This was 2 days ago in response to that strike. And then today, a senior Hezbollah commander killed in Lebanon. So it's an escalation back and forth, tit for tat. I feel, and I don't want this to occur. I mean, honestly, I think we would all be a lot better off if this conflict doesn't escalate, because it's not going to be great for any of us when the price of crude oil goes to $150 a barrel. But I believe we are on the precipice of a major regional conflict breaking out in the Middle East. I've been saying this for months now, and this is a problem that is not going away. In fact, it is getting much worse. And we need to be ready for that, because when that happens, Iran can easily shut down the Strait of Hormuz. Something like 20% of crude oil production flows through that strait, and that is going to lead to massive inflation. But here's the thing, the Fed is going to have to print no matter what, and the inflation problem be damned, they're going to have to print because of the amount of strain that high energy prices will put on an already crippled economy, and to support the spending that a war entails. Now, here's another sign that the U.S. economy is going to need a bailout. So the California State Teachers Retirement System, the country's second largest pension fund, this is from Bloomberg, by the way, may borrow more than $30 billion to help it maintain liquidity without having to sell assets at fire sale prices, according to a new policy its investment committee will consider this month. So they are taking on debt to avoid selling assets. This sounds kind of familiar. It sounds kind of like that BTFP program, which we'll talk about in just a moment. But To carry on with this report here, the California Public Employees Retirement System Board approved adding 5% leverage in 2021. This is adopting an investment strategy that could enhance returns, but potentially increase the risk of losses during market downturns. So that isn't working out so well for them. Now they're having to borrow more money, and they don't really get into it in this article about what these assets are that the California State Teachers Retirement System is so worried about selling. But if we explore well, no, this is not the article I was looking for. Let's see. Here we go. Here's one more recently. CalSTRS considered $30 billion borrowing strategy amid commercial real estate downturn. So they're sitting on a portfolio of commercial real estate properties which have devalued significantly and are likely to continue to do so until the Fed begins to print once again. Now, what do I mean? Well, let's talk about this. So we've got the CRE portfolio, commercial real estate portfolio of this pension fund, accounting for roughly 17% of their assets. It was one of the top performing asset classes for the fund until the pandemic hit and the Federal Reserve embarked on aggressive interest rate hikes. The use of leverage as a sporadic tool aims to provide a buffer against the volatility in the commercial real estate market, has witnessed a value decline, especially in office real estate, by approximately 20% due to higher interest rates. So it's the higher interest rates which are preventing buyers from coming into the commercial real estate market. That is removing the buyers from the equation, means less demand, prices have to fall. These pension funds are sitting on these big portfolios of commercial real estate. This problem is only going to get worse as many of these properties now have to be refinanced at today's higher interest rates. The Fed is going to have to get into the market and drive rates lower to bail out the commercial real estate sector and these pension funds. Otherwise, what's going to happen? Ultimately, should commercial real estate collapse, the California pension fund, what's it going to do? Say to the pensioners, well, now you get 50% of your money. Now you get 25% of your money. Not in an election year, folks. That's not going to happen in an election year. I guarantee that 100%. I mean, there's very few things that we can count on, but one is that the politicians are not going to allow the pension funds to collapse in an election year. Maybe they should, if the assets that these pension funds are sitting on, because the thing is, they're going to get a bailout, they're going to cut interest rates, everybody's going to get their money, but the purchasing power of the currency is going to be devalued. So it's a default by another name. The implications for pension plans and regional banks, this article here from Bloomberg goes on to say, the downturn in the CRE market is casting a long shadow not only on pension plans like CalSTRS, but also on regional banks, which have significant exposure to commercial real estate. Think about that. Think about the regional banks sitting on giant portfolios of devaluing commercial real estate, giant portfolios of devaluing low-yielding U.S. Treasuries. I mean, just look at this chart of the bank term funding program that we mentioned just a moment ago. Now at another record all-time high. It's been on the rise since the end of November, a pretty significant rise. $141 billion of the emergency loans to regional banks. This was implemented back in March, and you can see it is on the rise once again because the regional banks need a bailout. They need the Fed to come to the rescue. They need them to slash rates. They need them to buy government debt to drive the yield on U.S. Treasuries lower. And this is why, the short-term action and gold and silver prices, if they drop lower, I'm just going to keep stacking. I'm going to dollar cost average down. I mean, it's kind of a double-edged sword. I'm sitting on some gold and silver. It's nice when I see the price go up, but look, I'm not selling anything anytime soon because look, I mean, a lot of people say gold and silver, they're manipulated, especially silver. I mean, the gold to silver ratio right now is around 88, I think. Silver is just abysmally cheap right now. And, even in the comments on these videos, I read the comments. I read almost all of them. And I see a lot of negative sentiment out there around silver right now. I mean, look at the silver price. A lot of people say, it's manipulated. That's never going to change. Well, listen, if the silver price is manipulated to the downside, it's an artificially low price, that is to the stacker's advantage because all that manipulation is occurring in the paper markets, not in the physical markets. So I'm going to keep buying physical silver. I'm not buying paper silver. I'm buying the physical stuff. And, when the U.S. debt market melts down, and I'm not saying that's necessarily going to happen in 2024, but I think it is inevitable ultimately. When that breaks down, that is when the manipulation of silver, to the extent that it exists, is going to end. And the folks holding the physical metal itself, they're going to be the real beneficiaries. That is my belief. Let's finish up with this one from Statista. BRICS expands footprint in the global south. Here's another reason why, maybe not in the immediate future, but ultimately the Fed is going to have to buy a lot more U.S. government debt, why they're going to have to return to the printing presses. It's because these countries, the BRICS, a lot of countries are joining. You got Iran, Saudi Arabia, Egypt, Ethiopia, and the UAE. So some pretty big energy powerhouses. They're joining the BRICS group of major emerging economies. They just joined on January 1st, expanding the bloc's footprint in the global south and growing its economic and political clout on the world stage. South African President Cyril Ramaphosa said at a press briefing, "We shared our vision of BRICS as a champion of the needs and concerns of the peoples of the global south. These include the needs for beneficial economic growth, sustainable development, and the reform of multilateral systems." Now, that's probably the one that we need to focus on here when it comes to the Fed and the price of silver, because what that means is the reform of multilateral systems. I mean, I don't know exactly what he was referring to, but I tend to believe that in the context of the BRICS, that means bilateral trade between the BRICS organizations and the de-dollarization, or at least that is a component of their reform of these multilateral systems. The utilization of local currencies, perhaps the creation of a BRICS currency. I mean, we talked a lot about that in 2023. That didn't manifest itself. What we did see was the BRICS expansion. Those kind of were the two big things that folks were anticipating in August from the BRICS conference. I still think a BRICS currency of some sort, I don't know exactly what manifestation that will take, whether it be a pool of paper currencies or something linked to commodities or something simply backed by gold or gold and silver. Who knows? But it will be competition to the dollar. It will mean that less demand for U.S. government debt will exist among these BRICS nations. If they're not using the dollar for trade, they're not going to need to buy dollar-denominated debt. That goes doubly so for Saudi Arabia with the whole petrodollar arrangement. You've already got the UAE, selling oil for rupee last year. Expect a lot more stories like that here in 2024. And then Cyril Ramaphosa also indicated that the addition of the 6 new members is just the beginning of the bloc's expansion process. As the 5 BRICS countries, we have reached agreement on the guiding principles, standards, criteria, and procedures of the BRICS expansion process, which has been under discussion for quite a while. We have consensus on the first phase of this expansion process, and further phases will follow. So the list of nations that have expressed an interest in joining BRICS is a long one indeed. And this counterbalance to the U.S. global hegemony is only going to expand as time goes on. And I believe that that means that there's going to be a dearth of buyers for U.S. debt, at least compared to what there has been historically. And that means that all this debt that we're taking on, $1.6 trillion here, $1.6 trillion there, it starts to add up after a while. Someone's going to have to buy it, and it's going to be the Federal Reserve, ultimately, the buyer and lender of last resort, because if they don't, this whole system is going to collapse, and ultimately we'll probably see it collapse anyway, because a debt-based system like this is not sustainable, but that doesn't mean they're not going to give it their all. So that's pretty much it for this update, folks. Keep an eye on the inflation report later this week. That probably will have some impacts one way or the other on the price of gold and silver, at least in the short term. But ultimately, the Fed, whatever investors think, the inflation numbers are cooked, the jobs numbers are cooked anyway. For now, the Fed is, quote unquote, data dependent. They're looking at those things. But ultimately, they will be forced to print. I think they've already demonstrated that that is what they will do when the wheels start to fall off. And that's why I'm still stacking. So let me know what you think in the comments down below. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.